Let's get to the morning brief because big tech is out and the quote-unquote old economy is in. That's according to Bank of America. As tech stocks are no longer poised to lead the way for the markets. You can read all about that in today's morning brief over at the Yahoo Finance homepage. But for more of a deeper dive, let's get to the person who wrote it. That's Alexandra Semenova. So, Alex, interesting concept here as we were just talking about how there's sort of this positioning scramble, for lack of a better word, a little bit of confusion in the markets this year.
Exactly. The big name tech stocks that have been leading the way up over the past decade, thanks to, near zero interest rates, to easy money policies, their best days are likely behind them. And instead, the potential for upside really exists in capital depleted names, capital depleted sectors like energy, housing, materials. That's according to Bank of America. And they refer to these sectors as the old economy. So now is not the time for the Apples and the Amazons of the world. It's the time for commodity producers, for home builders, which are trading in record discounts right now, whereas tech continues to remain really overvalued. On top of that, Bank of America points out, based on equity risk premium, that tech stocks aren't pricing in recession risk. And of course, now with the sentiment shift, with this expectation for higher for longer rates, that's going to continue to pressure growth stocks, to pressure tech names. Now, bear market rallies typically do result in a leadership change. The leadership before a bear market is usually contingent on, the economy that is in place at the moment. But then when you see that transition, the leadership changes, to the new economy that takes place, which is happening right now. We're moving away from really easy money policy to an economy that is seeing rates approach 5%. So the stocks that benefited from the old economy aren't going to do well in the new one. We've already seen signs of this emerge. Look at what happened last year. The NASDAQ severely underperformed the Dow, erasing more than a third of its value, while the Dow was down less than 10%. Jared, I know you had pointed out that was the biggest gap since the dot-com bubble. So we are seeing signs of this.
Yeah, and another thing that tends to lead bear market rallies is short coverings. Those stocks that have heavy short interest. And a lot of those were tech and disruption names. So that can account for some of the strength there that we saw, I think, earlier in this year. But if Bank of America is saying that tech is out, what is the reasoning behind the rally that we saw that they say was behind the tech rally this year?
Yeah, well, that's the thing. What we've seen, many investors are saying has been a bear market bounce. It's not the start of a new bull market. We're already seeing the narrative shift. These names were rallying because of speculation that the Fed would pause and pivot, and we're getting all these inflation readings that are coming in hotter expected. The path down for inflation isn't as smooth as everyone thought it would be, and so sentiment is changing around tech stocks. Of course, we had the January effect as well, boosting, tech purchases during January, and we're seeing that really come down in February.